Welcome to Street Signs on CNBC TV 18. It was an extremely volatile week for the markets. In fact, it was a week in which the Sensex fell 850 points on Tuesday. There was an attempt to recover, but by the end of the week, you felt that the attempt was quite feeble, and the indices fell about 1.5% by the time we wound down this week. Udin Mukherjee joins into our conversation, and then in a bit, we'll get two experts as well to tell us how to approach the markets. Udin, hi, welcome to the show. By the end of the week, you still had an uncomfortable feeling. The markets seem to be quite worried or cautious about many events, primarily global.
Hi Sonia. Actually, it could have been far more uncomfortable had it not been for Thursday and Friday, because the fall at the start of the week was quite gut-wrenching. But the Nifty went down to 8100 and clawed its way back nearly to 8300. It's difficult to say, despite the clawback, whether the correction in the near term has come to an end, because Friday's pullback did not have great conviction in terms of breadth. The advanced decline ratio was negative. Mid-caps did not perform. Banks actually did not do very well on Friday. It's only stocks like Infosys post encouraging numbers, HUL, Reliance and ONGC, which sort of pulled the index back. So I think we need to see a little bit of evidence early part of next week to be sure that the correction that we saw at the start of this week has actually come to an end and the markets resumed its uptrend. My own sense is that the markets will probably need to do a little bit more work here. I wouldn't be surprised if there's more volatility during the course of next week, leading up to the end of January global events, which might keep the markets on tenterhook. So it's been an interesting week. It's betrayed a bit of nervousness on the part of the market from global factors. We are still not out of the woods in terms of FII flows, which haven't picked up in the last 4 or 5 weeks. So as we wade deeper into an earnings season, which is not expected to be great, I guess we'll need to see some more ranging trades, maybe a bit of volatility as well before we are out of the woods.
Fair enough. How do you approach a stock like Infosys post its numbers, Udin? I mean, this time there were no negative surprises. In fact, the margins were better than estimated. The volumes were strong as well. But IT has not exactly been the flavor of the month.
Well, the rebuilding process is on at Infosys. The market's priced quite a bit of that in because Infosys has been an outperformer over the last few weeks compared to even some of the recent outperformers like TCS and HCL Tech. With the way the stock closed on Friday, Infosys trades now at almost 17 times FY16 earnings on current expected profit numbers. So it's covered a lot of distance. My own sense is that despite the recent solid numbers, the stock might need to do a little bit of work out here and may not dart up to close the gap with TCS in terms of valuations quite completely out yet. There is still almost a 15% kind of premium that TCS enjoys relative to Infosys. That may bridge somewhat more, but I think Infosys, having gone up in recent times and having gone up or responded to the results which weren't bad, may probably start to run into a little bit of resistance around this 2100, 2200 levels, because valuations have priced in quite a bit of the recovery and some part of the good news. It may still remain an outperformer relative to the sector, but I'm not entirely convinced that IT has begun outperforming already after a single set of numbers. I think IT probably still, given global cues, might remain at best a market performer, probably still an underperformer.
All right, let's get some expert opinion now into the picture. Nirmal Jain, chairman of IIFL, joins in. Nirmal, hi, welcome to the show. Do you think that the minor correction that we started in December has come to an end, or do you see more hurdles in the month of January?
I think market will remain volatile and consolidate in the month of January, although medium to long term trend is becoming even better. But in the short term, I think few factors will weigh heavily on the market. One is global environment is extremely choppy and volatile. Two, earnings will be a mixed bag because say energy companies or commodities companies, they will probably not report good numbers. Most of the analyst upgrades and downgrades also have been mixed, and I think so one has to pass through this earnings season, and also there is a people will wait for the budget and people will wait for interest rate cut to happen. But if you look at little longer term perspective, say next year, FY16, then the outlook is becoming extremely positive, because if supposing dollar remains at $50, people are talking about 30, 35, keep that aside, but even if it's $60 on an average, India is a net importer of 900 million barrels a year, so that would mean something like $40–50 billion as a country, as a nation we save. I mean, that would be money down the drain, because you just import petroleum products or oil, you have to pay that much lesser. I mean, that's almost like we are talking about 3 lakh crores, which is not a small money. That is what will drive either savings or growth in investment. So all these factors, I think, will lead to earnings upcycle happening, say, from second half of next year. So, there are two sets of investors. There are investors who will probably look at longer term, long only FIs. They will look at this opportunity. So whenever market corrects, they will look at opportunities to buy. And there will be hedge funds, traders, and that kind of people who will look at the volatility. They'll be cautious. And they'll be more driven by the events that happen globally or maybe in India also. So I think market in this month will remain a little volatile. I don't expect it to resume its bull run immediately. Maybe nearer the budget or after the budget, it will have a clearer trend.
Hi Nirmal, in this kind of volatile range, do you see the Nifty breaking below 8,000 or do you see 8,000 as some kind of psychological floor which the index would not violate?
I think unless there's some catastrophic event happens in the financial market globally, I don't think Nifty will break 8,000 or 7,950, what is the technical level. Nifty will not break this because, as I said, there are a set of people who are looking at every correction or every fall as an opportunity to buy. So I would say that under circumstances which are known or predictable or whatever probably we can foresee with some degree of probability, Nifty is unlikely to go below this level. But if something happens that probably you and I can't forecast today or can't visualize today, then you can't. I mean, how equity markets are.
The other factor which has caused the market some discomfort of late is the fact that for about 5 or 6 weeks on the trot now, FIs have been on the sell side, December included. I mean, from the sales desk, what kind of inputs are you getting? What would you put this down to? And what could reverse this kind of selling which has come in, which is unusual compared to the experience of 2014?
Yeah, so in fact, what has happened is that the emerging markets, in FIs, there are a couple of things that have happened. One is that US has strengthened, the dollar has strengthened, and so the allocation to emerging market might have been reduced as one. Two, Indian markets were perceived to be at high altitude or had run up very swiftly, and most of the fund managers are also investors, and if they look forward to, they expect a correction, then they'll wait. But I think another important trend that we should not miss is the domestic investment, because we are seeing money coming through mutual fund, and we'll see that coming through insurance as well as direct equity also. If you look at the numbers from FY10 to FY14, our household savings, I'm not talking about total savings, the household savings has come down from 25% to 22%, and within that financial saving has come down almost from close to 50% to 35%. And if this trend reverses, then in last 6 years, household savings into financial markets has been something like $25, $30 billion. In next 3 years alone, it can be to the close to $75 billion. So I think as we have seen in the earlier bull market, the domestic money can play as a huge cushion against the volatile FI flow of money. But FI is also, I'm not bearish. I think this is just a phase. And once there's stability, or as we see budget, probably this will be, I mean, this, people talk about dream budget, but I think from the finance minister's point of view, is a dream situation or dream circumstances to present a budget in. I mean, he's got a stable government for next 5 years. He's got, the crude oil, the macro things are heading his way. Inflation is down. So I think we can expect a lot from the budget, and I think that can be a trigger point for FIs to come back in a big way.
Fair enough. The stock of last week, clearly, Nirmal, was HUL. It went up 15% last week, completely unfazed by the market volatility. Do you continue to see outperformance there?
See, in case of, Hindustan is a company that I worked for 5 years, so maybe I'm a little biased on this, but I think it's a great company, but more importantly, 50% of their sales are raw material, and raw material prices have been falling, particularly oil, and also the petroleum-based prices, they help in the packaging material, which is also a significant part of cost, when you have sachet and smaller packs. So I think a company like Hindustan Lever can retain these raw material price benefit because they have strong brands and they don't have to pass back. So the margins will, I think market may be expecting that margins will expand. The demand growth hasn't been very strong in last quarter, but I think people are expecting that demand will become stronger going forward. So I think these are the factors that must be driving demand for HUL stock.
All right, we'll take that caveat that you worked with HCL in the past, but we'll do one thing. We'll take a short break. We'll continue our chat on the markets and on individual stocks on the other side. Stay tuned.
CNBC TV 18, celebrating 15 years of leadership.